G'day everyone, welcome to this update for the 16th of November for the Australian and global markets. And there wasn't a lot of change during the week, except the Australian market went down, but certainly the overseas markets held up pretty well. And we saw a rebound in gold towards the end of the week as well. So plenty of movement on the commodity space. So let's jump in and have a look at what happened last week. The S&P is slowing down a little bit, but it's still rising. It ended up gaining 8 points on the week. And the volatility which spiked up in the first half of October has just completely gone away. And the VIX index, as we'll see, has basically returned to levels around about 10 and 11, which has been trading at for a good part of the last couple of years. I expect this rally now to continue into Christmas. I've been saying for many, many months that we would have a strong final quarter into Christmas. It got a little bit untidy the first couple of weeks of October, but since then the market has just gone straight back up and formed new highs, and so have all the good stocks. Now, members of Specialist Share Education would have seen a great deal of detail during last week on why I believe that contrary to most market analyst opinion, that in fact we've been in a secular bear market for much of the last decade and a half, and that we have just broken out into a new secular bull market. Now, secular means big picture. It's not the moves that last for 1 or 2 years. It's the moves that last for 10 or 20 years. And if that is the case, and I believe there are just an absolute mountain of evidence that that is the case, then we're looking at quite a substantial secular new bull market that started about a year and a half ago. Now, because they're such big picture events, you can't really pick them at the time. You can really only view them in retrospect, and that's generally at least a year or more in terms of looking back. And so looking back now, June 2013, I think there's every chance that both technically and fundamentally we've broken into a new bull market. And those new bull markets typically last anywhere from 15 to 20 years. Now, I provided a lot of detail and charts to members, so I'm not going to repeat that here, but certainly there's a strong case for that. So for me, we're in a absolutely fabulous wealth building period. Yes, there will still be substantial declines and substantial rallies. If you accept the basic argument that we're in a secular bear market from 2000 to 2013, then within that we saw some fantastic rallies up to 2007. We then obviously saw the GFC. So they're cyclical bull and bear markets, but they're not the bigger picture variety. So I believe we will get some spectacular rises. We'll probably get some very, very sharp declines. Could be perhaps 25, 30, 40% declines, and people will think that the world is coming to an end. But I believe if you know how to work within those cycles, then the next 15 to 20 years is just a fabulous time to be building wealth. Just quickly, the European indices, nothing has really changed. The DAX is in a phase 4 decline, I believe. It's hanging where it is purely on stimulus. There is a line in the sand that I've been talking about over the last few weeks at around 9,500 would negate the technical setup that I'm seeing. But I think there's still a very good chance that we are going to see over a period of time, we're going to see lower prices in Europe. Now the FTSE is also has confirmed into phase 4 and needs to close above that line in the sand at 67.50 to negate that. But I have to say that the chart of the FTSE is looking a little bit better now than the DAX, and economically there's no question that the UK is doing better than Europe. So let's have a look at some of those charts. We'll start with the S&P 500, and I'll just pan back here a little bit just to show you what I mean about these secular bull and bear markets. So if we pan right back, then you can see that the highs that we had in 2000 and then in 2008 were really exceeded in June of 2013, and since then the market has continued to rise strongly. And that's why I think if you look back on a big picture level, going back to the 1800s, then I think we are in a period of a new secular bull market that started in 2013. So that means that and if history is any guide, those secular bull and bear markets tend to last anywhere from 15 to 25 years. So I think we're in for a very extended period of good wealth building opportunities. But bear in mind, there will be sharper volatility. Now let's just have a look at the Russell 2000 index, which had also looked like it had dropped into a phase 4 decline, but has now rebounded and is back above its moving average. So we can just put that down to a bit of a blip on the radar at this stage. And just looking at the VIX index, you can see the massive spike that we had in early October. So just pan back and take a bigger picture look. So that really was quite substantial. It was a larger spike in the VIX than we saw at any time since 2011. But you can see as quickly as it went up, it just absolutely collapsed again. And therefore, I think there's a very good chance that that this little event here that only lasted a couple of weeks, the cynic in me is suggesting strongly that this was specifically engineered in the bond and currency markets to stimulate some additional volatility to the advantage of traders, because there was no fundamental basis for it. It just zipped straight up and then straight back down again. And people that were ready for that in the options market, I think, would have made a killing. I might be wrong, but I don't tend to think that's too far from the mark. Let's look at the DAX index. So nothing much changed. It declined a little bit on the week. To negate the phase 4 bear market, it really needs to get back above this red 150-day moving average. Hasn't quite done that yet. And the FTSE, of course, is the same, but looking just a little bit better. While we're here, just have a quick look at the ASX 200. We actually declined on the week, very disappointing, one of the worst performing markets around the world, and it was largely because of the banks. So the ASX ended up down 95 points on the week. All sectors were down, and especially the banks. And as I've been saying now for quite some time, bank valuations are at historical highs, and that is not consistent with the facts about where they are. Their profit growth has come partly from the write-down of provision for bad debts. That process is just about finished, so that's going to cut off one avenue for revenue growth. Our economy is slowing, no question about that. The credit growth is slowing. That cuts off another avenue for earnings growth. And there is also going to be a requirement for the banks to hold more capital as well, and that's going to reduce their capacity for lending. And again, that's a third reason that earnings growth is going to struggle. So for banks to be trading at a historically high valuation is just not at all consistent with the facts and where they stand. So value in the Australian market is really tough to find at the moment. Yes, we've got some great companies, some great growth companies that are going to grow very reliably and very strongly, but you're just being asked to pay an absolute arm and a leg to buy them, and there's just much better value elsewhere. Now gold has had a pretty rocky ride. It's $11 higher for the week, back up to $11.89, so it's getting back up to, it broke to a new low below $11.80. But it's now starting to work its way back into that range. So it could well be that it's just that was a false break. So stocks are looking better. The gold stock indices overseas are looking better. And if the gold price stays below $1,200 an ounce on a sustained basis, so I'm talking 6 to 12 months and longer, then the higher cost mines are going to have to close. There's no question, because they're operating at a loss. And that includes the majors. So that is going to cut a lot of supply out of the gold market. And of course, when you cut the supply out and the demand is still there, especially from China, then the gold price has to rebound. So it's not just a line on a chart. It's not just the fact that 1180 to 1200 was a key support level. It's actually, from a financial fundamentals point of view, it's critical that gold be above $1,200. Otherwise, the supply is just going to get turned off, and that'll be a self-correcting mechanism. Now, on a long-term view, and I'm talking at least a couple of years here, there is some good long-term buying in some of the best gold stocks in the US. If you don't know what the best gold stocks in the US are, then maybe I can help you with that. Copper, steady on the week at 307, still holding support, but it's still in an overall downward trending wedge, so not looking particularly good. Crude oil is down 32% from its highs and down to $76. And the way the supply and demand situation looks for crude oil, we could see even lower prices yet. However, there is a rebound in US oil stocks, so we might be seeing a medium-term low. I still think the trend for oil is lower, and therefore the trend for oil stocks is lower big picture, but they've been sold off absolutely savagely. So it's possible that we could see a rally for 3 to 6 months in oil stocks, signaling a medium-term low. There's the spot copper chart. Hasn't really done much for several months now, just between $3 and $3.10 a pound. And there's the nickel chart. Similarly, hasn't done a great deal. Let's look at the charts for gold. We'll start with gold on a daily basis, and you can see we had quite a sharp rebound on Friday, so that was a good session. Looking at it on a weekly basis, we've had a break of key support, and it formed a new low, and we've now rallied back to test that breakdown. So this is really critical where we are right now. If gold can quickly get back into this range, get back above, say, about 1220, then this might just be a very short-term false break, and we're back into a bull market for gold. However, that is unproven at this point in time. Let's look at the GDX index. So the gold stock indices also broke key support a few weeks ago, but you can see there's been quite a strong rebound, and when you can look at the volume on some of these major stocks. These are basically the top 16 stocks in the world in terms of gold production, and some significant up days on strong volume. So there's definitely some strong buying in this area. Now, overall, strategic approach, nothing has changed in the last week, so it's the same slide as last week. The overall approach remains, in my view, heavy emphasis on a small handful of key US sectors that members know what they are, and it's just a matter of picking off stocks that get grossly oversold, that are financially robust. And as I said earlier, I believe that we are probably have entered now an extended period, as in more than a decade, which will provide extraordinarily strong wealth building opportunities. But within that, I think there will be increasing volatility. I believe that we will see markets again like we saw in 2007, which was taken over by euphoria, pushing markets up to stupid levels, and then followed by substantial declines like we saw in 2008 and again in 2011. So I think if you look at the last 15 years, from 2000 to 2015, where there was a net substantial gain, then I believe we're going to see a similar sort of period going forward. In fact, probably even better, but really quite volatile. So if anyone wants any more information for people who aren't members of Specialist Share Education, there's my email address. Always happy to communicate, and talk to you next week. Cheers.